America pushed all its chips to the center of the table and bet the entire economy on one wager, that artificial intelligence arrives on schedule. Big tech is pouring money into the physical infrastructure required to run these models faster than anyone can keep track of. This chart shows the exact scale of that wager. In 2024, the biggest tech companies spent a little over $200 billion building AI infrastructure. By 2025, that number hit almost $400 billion, with current estimates now exceeding $700 billion. To see how much that matters, consider that AI infrastructure alone accounted for more than half of America's real GDP growth last quarter. If you listen to the popular debate right now, people are arguing over whether a chatbot is going to steal your job, or whether the software is actually a revolutionary tool. They are arguing about whether the code works, but that misses the actual problem. This visualization shows the core of the problem. The survival of the entire AI economy is trapped inside a race between two completely incompatible clocks. The first clock tracks the physical reality of American energy. It measures how long it takes to actually build the power grid, construct the massive data centers, and plug everything in. The second clock measures the financial reality of the hardware itself. It tracks how long investors are willing to wait for a return on investment before the highly specialized chips go completely obsolete. The real threat to the AI bubble is whether we can physically deliver the power fast enough to justify the prices Wall Street pays today. AI data centers consume electricity entirely differently than a standard office building. An office is busy during the day and quiet on the weekends. A data center runs full blast, around the clock, 365 days a year. They demand an immense, constant draw that the current grid was never built to handle. When a developer wants to build one of these massive facilities, they apply to regional grid operators, like PJM Interconnection, the largest in America. They enter an interconnection queue, which is essentially a mandatory waitlist to get clearance to tap into the power grid. This line graph illustrates the severity of that waitlist. Back in 2008, a new project sat in the queue for under 2 years. Today, that wait time has stretched to over 8 years, and getting permission is only the beginning of the delay. To actually generate that electricity, the grid relies heavily on gas turbines. They are incredibly complex machinery, and only a handful of global manufacturers can build them. Right now, companies like GE Vernova are largely sold out of turbine capacity through the end of 2028. Once you have the power, you need to step the voltage down using transformers. The supply chain for these machines is currently facing massive shortages, pushing delivery times out to over 2.5 years. Finally, to move that electricity from the plant to the data center, you need new transmission lines. Thanks to permitting delays and deep bureaucratic backlogs, completing those lines takes an average of 6.5 years. The delays are so severe that highly profitable tech developers are resorting to extreme measures. Some are entirely bypassing the grid by purchasing retired aircraft engines, bolting them to concrete slabs, and burning fuel to makeshift the power they need. This sudden, desperate demand for electricity crashed into PJM's annual capacity auction, the system where the grid buys guaranteed emergency power. For years, that backup power cost around $29 a unit. After data centers arrived, the price spiked 830% to nearly $270. Big tech has hundreds of billions of dollars to spend, but that money cannot magically summon heavy infrastructure out of thin air. When the global manufacturing base is maxed out, capital has to sit in line and wait. While the physical power takes a decade to build, the hardware waiting inside the data centers is actively dying. The cutting-edge semiconductor chips processing these AI models only stay competitive for roughly 3 to 6 years before newer, faster technology arrives and the old silicon slides toward worthless. When tech companies buy these expensive chips, they don't take the financial hit all at once. They use an accounting practice called depreciation. They spread the cost evenly over the years the hardware stays valuable, its useful life. But to make earnings look better, big tech is quietly stretching this timeline on paper. This shrinks annual expenses, artificially boosting reported profits today. Michael Burry, the investor famous for predicting the 2008 housing crash, believes these tech giants are hiding the true costs of this boom. He argues the true lifespan of these chips is much shorter. By extending depreciation schedules, the industry is understating expenses by billions of dollars. The accounting departments inside these companies can't even agree on the truth. Amazon recently extended its server lifespan to 6 years, only to walk some of it back to 5 a year later. Meanwhile, Meta moved the opposite direction, extending its hardware life to 5.5 years to lower its own costs. They are looking at the exact same silicon and reaching opposite conclusions. This creates a mathematical disaster. If it takes 8 years to secure electricity for a new facility, the multi-billion-dollar chips sitting on the racks will be obsolete before the grid ever flips the switch. This entire system is buckling under the weight of its own success. The intense demand for compute is what flooded the waitlists and broke the power grid, while the blistering pace of software innovation is what instantly kills the hardware's value. This data visualization shows Bloomberg's projected power supply line falling drastically short of actual AI demand. Their research forecasts that by 2033, America will face a 63 gigawatt gap between the data center capacity the industry needs and the electricity the grid can actually provide. To put that shortfall into perspective, every operational data center currently running in the United States today adds up to roughly 40 gigawatts of power. To deliver the future these companies are already paying for, America would have to discover a way to power a gap 1.5 times larger than the entire existing data center industry on a grid that currently has an 8-year waitlist. The math is a physical impossibility. Investors are happy to fund massive operating losses right now because they believe a massive payoff is imminent. But capital requires a return. It will not sit around for 10 years paying for decaying hardware while waiting for a gas turbine to clear a regulatory backlog. The AI bubble will not pop in a dramatic flash of technological failure. It will pop quietly, inside a boring accounting spreadsheet, the moment Wall Street realizes that all the money in the world cannot outrun physical reality.